The aftermath of the 2008 financial meltdown saw a historic economic collapse, leading to the failure of numerous major financial institutions. Yet one entity not only endured the crisis unscathed, but managed to leverage the upheaval to become the dominant bank in the nation, JPMorgan Chase. At the helm of this financial powerhouse sat Jamie Dimon. Dimon's connection to the world of high finance began early. His grandfather, arriving in New York in the 1920s with little, built a prosperous career in banking and brokerage. By the time Jamie was born, his father, Theodore Dimon, was an established and wealthy stockbroker. Dimon often spoke about his parents' strong focus on morality, emphasizing doing the right thing and treating everyone with fairness and equality. His mother was a pioneer in the women's liberation movement of her time. Dimon's youth was privileged, marked by attendance at elite private schools and summers in the mountains of Colorado. Despite this seemingly perfect life, the young Jamie harbored a profound and unwavering ambition to achieve greater financial success than both his father and grandfather. He quickly recognized that the finance sector was his clear path to achieving this goal. But first, he needed to attend a top-tier university. To his initial frustration, his application to his dream school, Brown University, was rejected. After graduating fourth in his class and facing the rejection from Brown, Dimon enrolled at Tufts University. Feeling that Tufts was beneath his academic caliber, he soon applied to transfer to Princeton University during his freshman year, only to be rejected again by an Ivy League institution. Convinced he deserved a spot at the nation's best schools, he decided the best way to prove his capability was to become the top student at Tufts. His efforts paid off. Dimon always exuded immense self-belief, sometimes bordering on arrogance. In 1978, he graduated summa cum laude from Tufts, securing his acceptance into Harvard Business School, a validation of his self-worth and ambition. At Harvard, Dimon continued to distinguish himself. He was a nonconformist, avoiding campus housing and wearing casual clothes while his peers wore suits. He was also a rare and outspoken Democrat in a class dominated by Republicans. He graduated as a Baker Scholar, an honor reserved for the top 5% of the class. Flooded with lucrative job offers from prestigious Wall Street investment banks, Dimon made a surprising choice. He declined them all. Instead, he accepted a salary one-third of what was offered elsewhere to work for a family acquaintance, the legendary financier Sandy Weill. Weill, whose father was a broker alongside Dimon's at Shearson Hamel, was impressed by the Harvard graduate. Weill's offer was straightforward: less pay, but the promise of an inside view of how a major company operates. Sandy Weill was a highly accomplished figure in finance, a master dealmaker who had dramatically reshaped iconic Wall Street names like Primerica, Salomon Brothers, and Citibank. Born in Brooklyn, Weill was driven to accumulate wealth, not through a typical job, but by establishing his own firm and leveraging capital. In 1986, he sold his brokerage firm Shearson to American Express for $900 million and became its president. Weill took a particular liking to the young Dimon, hiring him as his personal assistant. Dimon realized the value of this early break, acknowledging the role of both luck and a significant mentor in his career. He respected Weill's grounded nature and shared his desire to build something substantial from the ground up, much like Weill had done with Shearson Hamel through numerous acquisitions. Dimon saw Weill as a figure he could learn from and emulate to construct his own financial empire. While his MBA peers started at the bottom, Weill brought Dimon directly into his inner circle, where the young executive negotiated transactions worth hundreds of millions of dollars. By the age of 28, Dimon felt he was already at the pinnacle of the finance sector. However, this early success was fleeting. He was soon headed for a dramatic setback. The 1980s were defined by corporate deal-making. Following President Ronald Reagan's efforts to support corporate America through tax cuts and relaxed borrowing standards, the era of mergers and acquisitions boomed. Dimon's career flourished under his role working directly for the president of American Express. Wild's ultimate goal was to become the top executive at American Express, and Dimon was certain that helping his mentor achieve this would ultimately pave the way for his own leadership of the firm one day. Their ambitious drive, however, made them targets. A significant point of conflict arose when American Express owned a fund called Fireman's Fund. Weil and Dimon worked relentlessly to arrange its sale to Warren Buffett. At the last minute, the board vetoed the deal. Feeling betrayed, Weil resigned from American Express in anger. Although he encouraged Dimon to remain to support his new family, the 29-year-old Dimon demonstrated unwavering loyalty and resigned as well. This was a tremendous gamble, yet one that would ultimately result in massive rewards. Following his departure, the determined Weil, with Dimon at his side, was set on a major comeback. At 58, Weil was viewed by his peers as being past his prime, and no major Wall Street firm would hire him as an executive, a mistake they would later regret. Weil and Dimon were forced to seek opportunities elsewhere, aiming to acquire a smaller entity and use it as a base to take over larger companies. They soon identified an unusual target. Commercial Credit, a loan company in Baltimore, primarily served middle and lower-income consumers, often operating almost like a loan shark with high-interest, short-term offerings. It was a subsidiary of Control Data, a struggling computer disk drive maker, which was eager to sell for cash in 1985. Dimon tasked Dimon with analyzing the firm for a possible takeover. His findings were surprising. Commercial Credit was a poor performer, with a mere 4% return on equity compared to 15% for similar companies. Yet, Dimon recognized its hidden potential. It had numerous assets that could be sold and significant costs that could be ruthlessly cut, making it a very appealing bargain. They once again approached Warren Buffett for investment, but Buffett, convinced by his partner Charlie Munger to focus on quality companies rather than trying to salvage failing ones, rejected the offer. The comeback plan was on the verge of collapse. They had three potential ways to acquire the company: find a wealthy co-investor, which failed, attempt a leveraged buyout risking heavy debt and bankruptcy, or conduct a public offering to sell a portion of ownership to the public. Dimon was confident he could convince investors that Commercial Credit was an undervalued company ready for a turnaround. Weil committed a significant portion of his own wealth, buying 10% of the company, and offered 80% of the ownership to the public. Dimon, in his early 30s, invested everything he had, $425,000, into the company. They successfully raised $850 million, instantly validating their investment. Weil appointed Dimon as the company's chief financial officer and rewarded his loyalty with a substantial number of stock options. The funds raised gave the company the crucial investment-grade credit rating a finance company requires. After the takeover, Weil and Dimon immediately began aggressive cost-cutting, including laying off 10% of employees on the first day. In just 1 year, the business generated $100 million in profit and achieved an 18% return on equity. Credit agencies upgraded the company's rating, enabling Weil to borrow an additional $100 million. With this capital, they were ready to pursue acquisitions. However, their stock suddenly plummeted by 50% on October 19, 1987, Black Monday, a day of market panic and meltdown. While much of the financial world struggled to survive, Weil and Dimon saw an opportunity. Their belief in the survival of the fittest kicked in. With its strong financial position, Commercial Credit was better equipped than its competitors. They began buying back their own shares cheaply and acquiring struggling firms for next to nothing. Over the next decade, they became the most active deal makers on Wall Street. They even managed to acquire a much larger insurance company, Primerica, with Dimon as the key architect of the transaction. By the end of the century, their firm had ballooned into the largest financial conglomerate in the U.S., Citigroup. The official merger date arrived, with chairman and co-CEOs John Reed and Sandy Weill celebrating at a Citibank branch. Weill was now the undisputed king of Wall Street, and Dimon became the president of Citigroup, with primary responsibility for managing the firm's investment funds. Dimon was just one step away from becoming the most powerful figure in finance, certain that the CEO role was only a matter of time. But Sandy Weill had different plans. The 1990s brought an economic boom under President Clinton, marked by the first budget surplus in years and tax cuts on capital gains. Weill, the apex predator of Wall Street, used his political influence to lobby for the Financial Service Modernization Act, which allowed the merger of commercial banks and insurance companies, ushering in the age of megabanks. Weill rewarded Dimon by making him president of the massive Citigroup. By 1999, a perfect opportunity presented itself. Bank One, a poorly managed financial conglomerate based in Chicago. Its credit card division was considered the worst in the industry due to poor service and hidden fees, and its CEO, John McCoy, was known for lavish spending amidst poor company earnings. The board fired McCoy and desperately sought a turnaround leader. They unanimously decided there was only one man capable, Jamie Dimon. To show his commitment, Dimon fully invested his personal wealth, over $50 million, into Bank One stock. He strongly believed in skin in the game, that executives should share the risks they impose on clients and the company. Dimon, however, had underestimated the extent of the damage at Bank One, which was far tougher to fix than JPMorgan. The company was failing, the stock was low, and internal morale was terrible. Over the next year, Dimon ruthlessly cut costs, selling underperforming assets, reducing executive pay, and firing 12,000 employees. He eliminated executive entitlements like company cars, club memberships, and retirement plan matches, forcing executives to acknowledge their collective role in the company's failures. In 2000, he took $4.4 billion in write-downs and loan loss provisions, resulting in a loss of $511 million for the year. Counterintuitively, the stock price rose because Wall Street finally saw a leader willing to take the necessary painful steps. Dimon's single objective was building a fortress balance sheet, a genuinely sound one with real assets and no excessive leverage, capable of absorbing shocks. A year later, Bank One posted a stunning $2.6 billion profit. Dimon had achieved a dramatic turnaround, but his true purpose was to build a strong base for massive acquisitions. In 2002, following the dot-com bubble burst, Dimon was ready to strike. Amidst the economic fallout from the Federal Reserve's rate hikes and the 9/11 attacks, the broader market struggled. However, under Dimon's leadership, Bank One achieved a 59% return over 3 years, triple the S&P 500's performance. By 2003, Bank One was one of the few thriving banks. Since his firing from Citigroup, Dimon had patiently plotted his return to the top, establishing a reputation as a ruthless but effective turnaround expert, the exact quality a particular Wall Street bank was seeking. JPMorgan Chase, founded by the legendary J. Pierpont Morgan, had become a sleeping giant by 2003. The Enron scandal had cost the bank $135 million in fines and damaged its public image. The current CEO, William Harrison, was nearing retirement and knew the firm needed a leader with the same steely resolve as its founder. By 2003, he had found his man. Both Bank One and JPMorgan were looking to merge. The deal was a great fit. JPMorgan could use Bank One to bolster its retail banking business. However, the real prize was acquiring Dimon as Harrison's successor. Unlike Will, Harrison was not threatened by Dimon and explicitly promised him the CEO role once the merger was complete. JPMorgan Chase merged with Bank One, and a year later, Dimon officially became the CEO of JPMorgan Chase, then the second largest bank in America, lagging only Citigroup. This would not last. After taking the reins, Dimon reshaped JPMorgan in his characteristic style: relentless cost-cutting, reforming incentive structures, and most crucially, building that fortress balance sheet. Yet, to surpass Citigroup and dominate Wall Street, the bank needed to generate more profit. Dimon knew this would be challenging as the market was becoming recklessly exuberant, with Citigroup leading the charge in the massive housing boom. Chuck Prince of Citibank famously said they had to dance until the music stops. Dimon, recognizing the reckless behavior, chose to watch from the sidelines, convinced Prince would run Citigroup into the ground, allowing him to collect the pieces. The housing market collapse in 2007 signaled a deeper recession. The first major casualty was Bear Stearns. The investment giant, known for record profits from subprime loan securitization, suddenly faced collapse as the financial derivatives used to hide risk failed. The government stepped in, seeking a solvent firm for a bailout. Only one company on Wall Street had minimal exposure to subprime loans. Ever since becoming CEO, Dimon had systematically reduced JPMorgan's exposure to risky mortgage loans, ensuring the bank had high capital and liquidity. When Bear Stearns was on the brink, the federal government, still underestimating the crisis's gravity, turned to Dimon. JPMorgan, at the request of the Treasury Secretary, agreed to buy Bear Stearns to prevent a global crisis. The shrewd Dimon initially offered only $2 per share, but to appease shareholders, the deal was finalized at $10 per share. While the acquisition didn't immediately boost JPMorgan's profits, it cemented the firm's reputation as a sound and reliable bank and propelled Jamie Dimon to the very top of the financial industry. By the end of 2008, Jamie Dimon was virtually the last man standing. The historic House of Morgan was now the House of Dimon. JPMorgan Chase was viewed as the safest institution, attracting $200 billion in its money market management business in 2008 alone, while its commercial banking income rose by 27% amidst the recession. For Citigroup, the story was reversed. After Sandy Weill's retirement, his successor, Chuck Prince, oversaw a catastrophic exposure to troubled mortgage-backed securities. Prince was quickly replaced by Vikram Pandit, but the damage was irreversible. Weill, watching the storm from retirement, realized firing Dimon was perhaps the greatest mistake of his career, admitting he wished Dimon had been there instead of Prince. Despite their complex, father-son-like relationship, Weill must have been secretly proud of Dimon's accomplishments. By 2020, Jamie Dimon remained the only CEO on Wall Street who had led a major bank through the 2008 recession. What sets him apart is his principled approach. He operates on a core set of values, stressing honesty, daily effort, and admitting mistakes, and applies these standards equally to everyone, including himself.